when you're a new founder trying to raise funds, there are certain things you think that you could have done that would have made you better at raising funds. So here are the two things that I wish I'd done prior that would make me better at raising funds.
Brilliant.
The first one, bigger network. The bigger your network, the easier it is for you to make those connections to raise funds. And the second one, the better storyteller you are, the better you are to raise funds.
We've got the pleasure of having John Downie, founder of SteadyPay. How do you as a founder feel in terms of the workload, the pressure, the responsibility on the team?
So I'd say for us...
Welcome to Founder Metrics by Vested, the podcast where we dive into the world of hotshot business leaders and the metrics that drive their game-changing companies forward. I'm your host, Ifti Nasser, CEO and founder of Vested. Hi, I'm Ifti, and this is Founder Metrics. Today, we've got the pleasure of having John Downie, founder of SteadyPay, with us. John, welcome to the studio. You give us a bit of a potted history of who and where you are.
Sure, thanks. It's great to be here. So for me, as you mentioned, founder of SteadyPay. Prior to that, I spent a long time doing consulting for banks around the world, generally in financial services, which is where I got sort of a lot of the experience, a lot of the ideas. I then started and exited a consulting business prior to founding SteadyPay.
Started and exited?
Yeah.
So why did you exit that?
So hilarious. I think it's one of those hilarious ones that, I was actually reasonably good at consulting, but I found that when you actually...
Was it charm, was it?
No, not really. Running the business wasn't as exciting as actually doing stuff. So consulting itself is fundamentally a sales funnel.
Yeah. When
you really think about it. If you're running the business, it's just a sales funnel and you're not really getting to do any of the execution. So it was quite an admin heavy role. And by the time I got it up to sort of a decent number of people, I was like, okay, what
did you get it up to? What was the decent set before
so obviously that was across Australia and New Zealand, which is maybe you'll start to see where my funny accent from.
It's subtle.
Subtle. Yeah, my London accent is got up to about 40 people, and then it's still going to this day. So
you sold it to PwC or
no, not quite. Not quite. That was also very common in terms of scaling up businesses. But we had the option to do that, but the other directors wanted to keep going. So
all right, so they've carried on. And you've moved on.
Correct. Yeah.
Brilliant. So SteadyPay, interesting business. And John, just give us a little bit more of a background as to where it came from.
Sure. So I think really got a little bit of insight that I was having spent a lot of time building financial service solutions, and a lot of that time, some of that time was spent building, credit risk engines.
Yeah.
And what I was seeing when I was doing a lot of work for a lot of the banks was fundamentally this, what was appearing to be this bigger and growing population of people that were excluded from traditional services. And a lot of them were freelancers or gig workers. And when you looked at them, you're like, actually, they look quite good. Why has the computer said no?
Yeah.
And that was and I built the computer that said no. So here's sort of the problem in itself. The computer's saying no, I built that. How do
it's like Norton?
Yeah. How do I turn that no that I built into a yes for these people that I'm looking at going, actually they're quite good, and that was the fundamental genesis from a SteadyPay perspective. We're seeing this massive growth in gig and freelancers, that if you turn up to a traditional financial institution and said, hi, can I borrow some money? The answer is no. Yeah. And the answer is no for them very obvious reasons. Oh, your income is irregular. We don't like it. Yeah. Oh, you're relatively new to the country. Oh, you're relatively young. Oh, you haven't built up a large credit history.
Some of them could be very credit worthy.
Absolutely. So I think it was what we were thinking of as, you hear various phrases of this sort of, you've got prime customers, great, they're easy to decision on. And then you've got that massive segment of non-prime, which just continues to grow. And in reality, non-prime is all subprime. No, there's effectively near prime or misidentified. So, and even more so, as we're seeing in the last few years with people immigrating into various countries, they're turning up, and they're potentially turning up with a credit card from their home country in their pocket with a big limit on it. but their credit profile in the country they've immigrated to is zero. Can I have some money? No. What do you mean no? So for me, it was sort of a crazy thing to see lots of credit eligible people being turned down, and then also seeing actually these people that we're working with and talking to them. It's a massive growth area in terms of people continuing to choose freelance work and to work for themselves.
Absolutely. I mean, whether it's Upwork or the proliferation of people doing their own thing or taking control of their own lives is massive. And as a consequence, if this remains to be a real problem, then it's shouting out to be sorted. So you've started sorting it. You just get some fundamentals in terms of the folk that you're working with. What's the sort of size of their income? Let's say classic gig worker. What's the range? I mean, some of them I would imagine are pretty high paid advisors, consultants. Some of them maybe in the hospitality world. What's the range of people that you serve?
So what we found is that, and this was very interesting for us, that when we first started this, we had a very, what I class as a traditional view of gig. Oh, it's Uber, it's Deliveroo, it's Upwork, it's that sort of thing. And what we quickly learned is we were wrong, and not wrong in a good way, because he's gig workers, still a big number, 4.6 million in the UK and growing. But actually, anyone paid by the hour, shift, or gig falls into this bucket. So what it meant is actually it's almost 20 million workers in the UK alone, and again growing. So everyone, yes, retail, hospitality, logistics, transport, but then you're in construction, healthcare,
it's just endless.
Civil servants. The British Army are quite big. Who would have thought? I mean,
British Army.
It turns out we pay our soldiers on an irregular pay scale. I didn't realize it until they started signing up.
How bizarre.
But I think that gives you the flavor. And then in terms of like actual, monetary figures, we've got the two extremes. We've got the average, but so we have people on the platform that get paid £50,000 a month, which is a stupendous number. And we have people that get paid in the small hundreds a month. In reality, though, the average tends to sit around that sort of 2,000. So that's the take-home pay. £2,000. Yeah. And what we've seen is, and that's sort of across the UK. It's a little bit higher in London, but not, there's not actually as big a discrepancy as you'd expect to counteract London living costs.
Yeah. And that 2,000, is that your mean, or is that the median in terms of the vast majority? Because you can imagine people on either end of that. Scale.
So that's the vast majority sit quite tightly around that, with sort of the extremes being quite long tailed.
And in terms of how you win those people, going back to addressing those different ranges of people from a marketing perspective and from a customer acquisition perspective is very difficult. So I'm guessing you've found your niche. And is that number, that 2,000, is it consequential to your marketing, or did the marketing or the business development bring you those, and then you decided that's where you're going to focus? Which way around was it? So
I'd love to sound like I had some sort of prophetic, here's what we did and that's exactly how it worked to plan, but 100% no. So what we because just like it was much more segments than we thought, which is great from a risk standpoint. Yeah. Similarly, it was more what we saw from the people that we were attracting. It was those types of people that were resonating with the product. So those were the people that we were getting, and then the more we listened to our customers, the more we built out our solutions around them.
Right. So you've been going for 6 years now. How many customers? How many individuals are you now serving?
So we're approaching sort of the tens of thousands in terms of individuals served, and we're continuing to sort of grow these days at about our target, because it's about 10% a month, and we're sort of hovering around there at the moment, which is quite nice.
And the business model, just very simply, I know it's very straightforward, but it'd be good hearing it from.
No. But so from a business model perspective, We charge a fixed monthly or weekly subscription in exchange for access to the services. So we think of it like Netflix or Spotify for credit, which our customers really resonate with, because a lot of them have had really bad experiences with debt in the past, where they've borrowed £500 and that £500 has become £1,000 somehow. And that's sort of
compound interest and all sorts of rubbish that goes on in the background.
Exactly. Compound interest is only your friend if you're an investor. It's not your friend if you're eating that compound interest. As home mortgage owners are seeing now as interest rates spike in that space. I mean, and it's probably also worth just adding, when we think about our sort of core products that were built out. So, income smoothing was the initial product. Yeah. And the easiest way to think about income smoothing is normally in $2,000 a month. This month I earned, $1,700 because I had got left shifts. I was sick. I took some time off. Doesn't really matter. We're topping you back up to the 2,000, so advancing the 300, and then you're paying that back in 3 equal installments afterwards. What we've, I guess we're talking about before in terms of listening to our customers. By listening to them, they're like, actually, I also want to build my traditional credit score. Well, good news, we can do that. But maybe they don't have as variable income. So we also added a credit building product into the solution, which allows everybody, that even the immigrants are my favorite example. So we had a number of Ukrainians that sign up. We've had lots of other immigrants sign up, and we've seen them over the course of like a 12-month period jump up 2 credit score bands. So they'll start out as poor, they'll go to fair, and then they'll end up in good. And that's and then we get to we can talk a bit later about what that really means in terms of moving
literally
from
that. I mean, it's one of the even though, as you say, that income smoothing capability is great. But what I found really interesting was that credit score build up, because it's not easy to quantify what that credit, have you got a good credit score, bad, etc. And that you may be less likely to get a loan as a consequence, or even a purchase on the back of a low or moderate. But how do you quantify the benefit of that credit score? How do you make it numbers?
So what I like to do is use a tangible example. So my favorite tangible example for quantifying the benefit of a good credit score is I want to buy a car. Yeah. So I want to buy a car, but and let's say it's £10,000, but I don't have the immediate funds to buy a £10,000 car, so I'm going to buy it on finance. So if I go to a car dealer and my credit score is poor, the chances of them financing me on the car are actually quite low in itself. So they may not give me financing at all. So sorry, you can't have a car. But I need a car to work. Or no problem. But let's say that I was still poor, but they were going to give me the finance. They would be financing that car at an interest rate that was well above probably 20% for that car. So you're fundamentally paying thousands of pounds. So in this case, let's say I finance that car over 3 years to pick and that's a short time frame generally to finance a car. Over the course, if I'm paying that 20% on the car, 20% doesn't sound like a lot. But then if I tell you you've paid £8,000 in interest for your £10,000 car that is now worth £6,000 at the end of 3 years, it really doesn't sound like a great deal. But what about if I said, actually, by moving up a band, instead of paying £8,000 in interest, you'll pay £4,000. Or if you move up another band, you won't pay £8,000 in interest, you'll pay £2,000 or £3,000. So you're suddenly that £10,000 car, you've paid £2,000 or £3,000 of interest, which over the course of 3 years, actually, it's not a bad deal.
It's a brilliant deal. So have you had to make that manifest and clear to people, or do you think people come to you understanding that advantage and are building that up? Which way around is that going at the moment?
So I would say we're definitely still learning how to communicate that clearly, and I think we've gotten better over time. There is a percentage of customers that come to us understanding that and knowing that, but it's still not the majority.
Yeah, so, I mean, I would assert that I'm financially aware. I understand what's going on, but I wouldn't have been able to do that assessment that you've just made so clearly.
Yeah, and that's the thing. That's the same for most people. Like, and the reality is that most people don't do it. And what we've found is a lot of our customers do err towards the can you do it for me? Because I trust your financial acumen. while I can learn some things, how can you help me? And that's where we're sort of trying to find that. I've almost found that sweet spot of being that sort of champion for our customers and enabling them to do more things. So it's they don't have to do them with us. You know, they get a bit of credit score. Do we lend for cars? No. Do we have any plans to do it? No.
So what Founder Metrics is all about, John, as you know, is really trying to help business leaders look at how they look at their business, metrics, numbers, how you can assess where things are going right, where things are not quite going right, where they need interventions. So let's just start with the obvious one. For you guys, what's your North Star metric?
So our North Star metric has changed over time. So
okay, that's an interesting piece.
Which is an interesting piece. Why I throw it out there is an interesting piece. Because if we were talking about, first, early days, 12, 24 months, it was something else we get in a second, versus, where we are now in terms of, North Star metrics. And a lot of the times, if you ask someone what their North Star metric is, they'll give you something that's either very vanity or very customer focused. Oh, we're really into NPS. Well, of course you are, because you have to listen to the voice of the customer. We'll get to that voice of the customer. But nowadays for us, you have to be, I think in the modern business environment, you have to be quite ruthless on what you're tracking. And
you can track everything.
Oh yeah.
You've got data. You've got the tools you can track everything to the end.
That's part of the problem, though, because then here's 100 numbers. Which one's important? Or here's 20 numbers. So you need to try and get it down, minimize the noise and get to the North Star. So for us now, what we're really looking at is what is our, where are we at on a run rate revenue basis, and is it growing at the rate we expect? And the reason for that, because you get to you start to break it down, like because if you're just saying, are you growing users? That's great. But are those users growing revenue? I don't know. So we need to break it down and sort of asking ourselves sort of the set of questions about, how are you managing the business? Okay, well, at a top level, how are we doing from a cost and a revenue perspective? Then as we go underneath that, so think about it as revenue growth rate and how that applies to cost, because we'll get to how it's the top line cost at a monthly basis, and then actually, where we're at from how much did it cost to acquire those customers. But that's when you get into that next level of detail. Yes, great, revenue's going up, or it's growing at this percentage. Now, how are we doing from a customer perspective? So what does it cost us to acquire that revenue, and is it within the boundaries that we find acceptable? And that's where people talk about CAC and CAC to LTV and those sort of things we can get into. But that's that fundamental next question. Are we growing? Yes. Are we growing cost effectively? Next question we want to know, and then we start getting, for me, into what I class as more of the leading future indicators. That's when it's what are our customers saying? Where are we at on Trustpilot? How are we looking from the qualitative feedback surveys we're doing? Because that's going to tell us things about the products we have in market now, and give us insights into the products we want to do next.
Building out, and so let's just pick this up. I mean, in terms of CAC to LTV, do you have a minimum, and below that, are you just not looking at those customers, or how do you? What happens because you'll have customer types, you will have created enough filters, and I'm sure. Yeah. So how do you segregate and actually let go of people who've come to you? The CAC's been spent. Yeah. To a degree. Yes. So certainly when it's the marketing aspect of it. So what do you do?
Yeah, so it's a really good question. So for us, what we do. So I mean, come back in terms of components. So do we have a minimum? Yes. Yeah. The minimum is a 3x. So because people want to know numbers. What's the number? It needs to be 3. Why does it need to be 3? Because all the VCs and anyone who wants to invest in you needs it to be above 3. Yeah. And you go, that's why. I didn't make it up. That's just how it is. Then we do segment our customers out. What we do find is if we're not paying enough attention to a segment or enough attention to a particular product, that can dip. Some of them are recoverable. So if you're at 2.7, there's probably things you can do to bring it back up. If we're finding that it's actually quite low, then it's really going back up the chain to be like, how are we targeting those customers? So back to what we were talking about earlier, we are quite targeted in our approach and quite granular in a lot of our, whether it's advertising or whether it's engagements that we do. So we know that actually this is an engagement with healthcare professionals or with healthcare professionals in this region. So actually healthcare professionals, it's a bad example because healthcare professionals are quite good for us, but let's say they weren't, we're going actually let's stop targeting those. So you're still potentially going to get some organically, which you can't help, but if it's an organic one, it's pretty much free. As opposed to if you're paying it, because you're right. Yeah. Once you've paid the CAC, you've paid it. That cost of acquisition is a sunk cost, and then it's a question
of what reward you can get for
what reward you can get for it, while still, and that's that balancing act of that you need to have an economic business, but at the same time, you need to have that value exchange with your customer. So, how are you creating enough value for them, even the ones who might not be 100% right? Or for us, let's say someone was on the income smoothing product, they've transitioned to a fixed salary. Our system is AI enough now that it will detect that and basically automatically say we're going to switch you to another product, which is part of consumer duty if we're getting into financial stuff. But
So when you're looking at the customer base, let's just look at some metrics. So we talked about you as the founder having to keep an eye on not just North Star, but all the other indicators and signals that you're getting that the business is on track. You talked about CAC to LTV and how you're growing that. What are the signals that you look for from your customer base? Is it churn? Is it downgrades? Is it how do you know that you're serving rather than that the market is in a difficult place, for instance?
Number one for us, and I can almost picture my dashboard in my head, to be honest, is retention. So the retention rate over time. So for us, we're looking to see someone signed up. Have they left in the first 30 days?
30 days.
30 days. Have they left in the first 30 days, and then what do they do after? What do they do after that? I'd say there's been periods for us on certain products where we have had, could have been 30 or 40% leave in the first 30 days, and that was a red flag. We need to do something. Whereas it was quite nice that I just had an all hands meeting with the team this morning that we're sitting there with a 90% retention rate in the first 30 days, which is what you want to see. But to your point, it's not so much in the happy days scenarios that's nice. It's what do you do when it's not happy days, and that's where it starts to get interesting in terms of more detailed indicators. So for us, if I see that first 30-day retention is particularly down for a particular product or overall, the first thing I'm planning to do is some of those leading indicators around customers. Have we gotten some recent Trustpilot reviews that are negative? Have our the survey results that we're doing, because we survey our customers on an ongoing basis. We'll call it a pseudo NPS. What is that telling us? We've got a group of champion users that we can talk to, and unfortunately for a lot of people that's going to sound like a lot. It's because it is, because that's what you need to do.
Yeah. Okay, so that's on the customer side. You mentioned the team. How big is the team now?
22 now.
So for a business that's been going for 6 years, tens of thousands of customers, 22 is a very, very lean team, I would suggest.
Thank you.
Therefore, just taking metrics, that's a good low number. How do you feel about that? Do you feel how do you as a founder feel in terms of the workload, the pressure, the responsibility on the team? Is it good? Is it getting to the edge of your lean outfit, your lean startup?
So I'd say for us, given that we launched in anger to the market at the start of 2020, and we probably had about 10 people at that point. So we've grown as we need it. But we've always sort of thought of it as a lean startup, not lean startup team, but as a lean startup in terms of what we need from a business. So relying on the technology, relying on our engine, relying on the systems, and then as we see areas that either need intense focus or where we want to start taking those hats off as founders or founding teams, starting to put the right people in place. I almost think of it more from an organizational design perspective. So anyone that's sort of looked at or is interested in organizational design, hit me up. But it's ultimately the design of your business is going to change over time, and your org structure is going to change over time. It absolutely makes sense. However, as you start to get to the point of like, okay, we have some level of product market fit. I'm no longer, doing everything. You're sort of past sort of 10, 15 people. Yeah. You're starting to go, okay, the org structure should be erring towards, not infinite scalability, but a level of scalability.
Next level, yeah.
So if you said, I'm a B2B SaaS business, then your B2B, SaaS sales function should be a nice little skeleton that you can just add people to as you scale it out. And it's the same across, whether it's paid marketing or other bits and pieces. So for me, that's how I sort of think about it now at that sort of 22 stage. As we see areas, we can just sort of plug more people into those areas to grow functions out.
So you feel that you're at that stage now?
We're at that stage. Definitely at that stage now. And I'd say as we grow into next year, we'll definitely be looking to hire more people again. I've been very conscious of, and it's probably meant that in some areas we've grown a little bit slower, which we can get to. Very conscious of building out a business with a strong economic model, and driving quite hard towards a profitability, or at least a break-even style business. A long time before that was a sexy concept. So it meant that there were times like, we should hire another 20 people. I was like, I don't really want to, because then you get to the when you talk about that cost of running a business. How much are you burning, and can you realistically sustain that for a considerable period of time?
And you can't just keep adding people to the list, because each additional person is an additional node, and while they're all needed as part of the game, it adds complexity to the business as well. So large numbers is not the only route to success.
Yeah, absolutely. And I know plenty of other founders that there are those points where either it requires a restructure, or you have culture problems, or you fundamentally have these growing pains, and you can have growing pains in different ways. But one of the easiest ways to get significant growing pains is hire loads of people really quickly.
And sometimes you need to. I mean, you especially if you build out the lean methodology for too long. At some stage, there are going to be weaknesses, and sometimes just then especially if you've got 15, 16 people. One person leaving or falling ill or whatever can create a massive amount of disconnect through the organisation. So it's a balancing act, and that's where the founder's wisdom, I guess, comes in.
Absolutely, and I think that's to come back to the other point on sort of stress, or feeling the pressure. Despite my laid-back Kiwi attitude, do I feel the pressure? Yes, and I think it's important to acknowledge that and be able to talk about it. For me, I usually find the best, while you've got friends and family, they don't generally actually tend to understand the founder journey. So as well intentioned as they all are, they really don't know what you're talking about, and they really don't care. So it's usually best to find other founders, because they sort of 100% empathize with you, and whether you want just someone to listen to you, or whether you want some advice, they're usually the best source. And there are a number of founder groups for it.
I couldn't agree with you more, John. I think there's almost like two different types of humans. There's many types of humans, but certainly founders as one type is very different. You'll have lots of people, saying they're experts in entrepreneurship or whatever, but they're employed by a big consultancy or a big bank. It is not the same. Living the life of a founder is, as one of our earlier, one of the folk we were talking to before mentioned, it's like a fairground ride. Those ups and downs cause interesting things going on in your stomach.
Yes, it's absolutely a roller coaster
and
ride.
not many other people can appreciate unless they've been there.
Yeah, absolutely. It's a huge roller coaster ride, and depending on it, could be up and down multiple times in a day.
Yeah.
Never mind multiple times in a week. And I agree. It takes other founders to sort of appreciate that. And what I've also found is that from an advice perspective, I've always gotten the best advice generally from founders that are, we'll call it, are 6 to 12 months ahead of me. And I think it's just because that's they're the most immediate.
Feels real.
Feels real, and they've had the experience, quite recently.
Yeah.
Whereas if you spoke to someone who was at Series E, like, what are you guys at? I don't know what you're talking about.
Yeah, because you're covering so many bases as a founder. You have to let go of the old bases when you move into the new paradigm, because you've got a whole new set of bases to cover. So you have to keep letting go. I think it's a very understandable behaviour and approach. But talking about the ups and downs, and talking about credit and gig economy, the world's gone a bit bizarre over the last few years, to say the least, and certainly the last year has been particularly strange. How are you finding that? Are you finding that you're getting more people into the gig economy and therefore more demand for your services? Are you finding it more difficult to serve people because of the uncertainty of income? Is it going to cost them more to come onto SteadyPay?
All valid questions. So I mean, let's break it down to gig economy itself, or freelancing, variable work. If we take the time period between, since it's metrics, we like metrics, right?
Yeah, well, that's what this is about.
So if we take the time period between, say, 2010 and 2020, the normal economy in the US and the UK, they're about the same, grew about 1%, so 1.1 for the US, and the gig economy grew 15%.
Massive.
So fundamentally, the bulk of economic growth is there, and that's where it's trending to. So the expectation is in the US, by 2028, 52% of the population will be freelancing.
Wow. Versus what's it now?
So now it's about 32
already.
So it's so it's quite big now in the US, because the US have no safety net whatsoever, and everyone needs a side hustle to be able to pay for, I don't know, private healthcare, or their I like Trump or I don't like Trump hat, or whatever they need. So metric wise, it's gig economy here to stay, growing.
I agree with you. I think you're right. It will, but going back to how those people are feeling in this environment.
So in this environment, would say mixed feelings, and this is because when you really think about it, and this is true even 5+ years ago, people are. It depends how you choose the gig economy work. And when I say choose, I mean, are you forced into it? Mm-hmm. You've immigrated to the UK, and this is the first job that's come up, and therefore you're doing it, or you've chosen it because that's what you really like doing, and there's a level of flexibility.
Post-COVID, you just wanted to change your work-life balance, whatever.
And sometimes that psychological baseline has a big impact. And then really the other part is, are you able to earn enough from doing it to live a standard lifestyle? And that's where you start to get the stress added now, is that additional cost of living. And what we've seen from for a lot of our customers is ends up being a shameless SteadyPay plug, is when you move from living that sort of paycheck to paycheck, you're obviously stressed, because am I going to be able to pay the rent this week? Am I going to be able to afford to do this or that or the other thing? Whereas, actually, I do have a relatively stable income. Actually, I can think about next month or the month after that. So it does create that level of psychological safety. What we're seeing from our customers, they are feeling nervous. It's a scary time in the world in general, and and there's lots of things to be nervous about. I'd say the pro that they're seeing is that there's still a lot of work. So what we tend to do with our members, it's one of our future directions, is you see a lot of solutions out there about managing your expenses. You should spend less on coffee or whatever. What rubbish advice? I need the coffee to live. I've got 3 kids or whatever the answer is, as opposed to how do you optimize your income? So that's one of the things where we're going is, yes, now we've started to provide that safety net. How do we actually start to help people optimize their income, actually get them to earn more money?
Yeah. And so going back to the point that I was trying to get to earlier on, given that uncertainty of money, would it be fair to say that uncertainty has increased?
Yes.
And if the uncertainty has increased, has the cost of serving them increased? So, because I guess it comes with a risk profile.
It comes with a risk profile, and I'd say the cost to serve has increased from 2 perspectives. So, I mean, if we go back 3-4 years ago, and the cost of underlying capital, lending money, was significantly less than it is now. Interest rates have gone up. So we're seeing that cost to serve come from a couple of perspectives. So there's a slight increase in risk, although I would say that the pro for us, and this is I guess one of our competitive advantages I'm very proud of, is we now have our risk and affordability engine is an AI based multi-model. Billions of transactions have gone into it now. It does. It's been a long time, and a lot of transactions learning, but now does a really good job. And what that means for us is that it's continued to learn and does a great job of managing risk for us, but also does a great job of managing risk for the customer, which I actually quite like. So it does it for both parties, because it's a bit of a case of because we're not only underwriting or doing risk and affordability at the time of sign up, we're doing on an ongoing basis. We can see how our customers are, are they getting better or not? And obviously, we're trying to encourage them to get better, but there could be other things in their life that are actually, that are actually impacting them.
So, given that you can see all these things, and going back to the metrics, if you see a customer's going south, for want of a better phrase, how do you handle that?
Good question. I guess it depends on the velocity of south. So what I'd say is we have a great customer success team, and what we found during COVID was that there were a lot of people that actually contacted us and said, "Oh look, not sure I'm going to be able to pay you back because actually I'm not working." No surprise there. And what we found was that this is an amazing concept. If you treat them like a human being and you give them a bit more time, they tend to pay you back. As opposed to if you treat them like a bank and go, "No, you must pay on this date or we will do this." They don't
default, and you're not going to get the money anyway.
Correct. So we found that sort of treating them like a human was quite good, and we sort of baked that into the process, even some of the automated stuff now.
Yeah.
So what it means is that if we're seeing them in sort of any level of distress, we're going to be prompting them in a nice way. And we've had it at times where people have been they're underpaid by a certain amount. We're giving them an advance, and they've contacted, I need more. But then those same customers that have said they needed more have actually contacted us later to say, "I'm glad you didn't give it to me." And
I'd have spent it.
I would have spent it, and I actually couldn't have, and I wouldn't have been able to afford to pay it back. So thank you for you or your system or whoever did it, but actually, you were looking after my best interests by doing it. So I think it's that combination of being very clear and transparent in our communications with customers. If we do get to the worst case scenario of actually we can't give you any more money, we're very clear about it and clear about why. So and that's I think for us, trying to look out for the customer's best interests, not just the what people are saying now. I must comply with the FCA. No, it's how do we do right by the customer.
So if you end up saying no, and you're trying to help them manage their credit score as well, does that go onto the credit score algorithm and mechanism? The fact that you have decided, because just like with insurance, you've decided not to forward any further funds to these guys.
So no, it doesn't, but what we're trying to do is work with them to sort of help their credit score build. So there's a lot of areas where a good example.
But you have to be honest.
You have to be honest, 100%. But I think it's a good example. Let's say if you were on just our credit building product. Unlike some other credit building products, there's a few out there, ours actually lends you money, which is what you really need to build your credit score. And 2, you can also cancel it at any time. So a lot of people sign up to a 12-month contract and you have to buy out the contract. So for us, if we were seeing someone saying, I can't afford it or I don't want to do it anymore, just cancel it. So therefore, there's actually no, we've positively built your credit score, but we're not going to negatively impact your credit score. Going, oh no, you didn't pay the other 6 payments of your contract. Actually, you can exit that at any time. Now, if you go back to if someone's onboarding and we're making that onboarding risk decision, then we will let other lenders know that we've said no, because it's I do believe in the give to get view of sort of if you're getting a lot of credit reference information, not we're really using it for a lot of stuff, but we rely much more on our open banking data, but we are contributing to the ecosystem. So I think
if you take them from the ecosystem, you have to contribute, otherwise it's going to die.
Yeah.
So you talked about open banking. I guess that's changing a lot of the way we all work and the information that's available about us. So how are you using that to your advantage? And I guess everybody's going to be working on this advantage. So don't tell any big secrets.
I'd say you know this from a founder perspective. Ideas are cheap. Execution is what counts. So I remember early on, I'm protective of my ideas. Now I'll just tell everyone. So from an open banking perspective, that's our primary input. There are a few other things into our risk decisioning and affordability engine. So transaction banking data, for those that aren't familiar with what we really get from an open banking perspective, it's a read-only connection to your primary or other bank accounts. We're pulling all that data in and then feeding it into our machine learning. Big pros, obviously it's pretty much real time. So it's a credit reference agency's score is generally quite old and based on quite old data. Whereas we can have sort of up to the minute effectively a view of your finances. You borrowed some money yesterday, or you got a bonus, or whatever happened. You got a new job and got
so you can't have somebody with a good credit score last week going out and milking every bank or opportunity. Now it's and
it makes it much more different, but it allows us to be very fair and transparent in how we do it. Now, obviously for us, it's a lending use case. There are others that do a PFM or personal financial management use case, where they're going to give you insights and recommend subscriptions to cancel, or bills or places you might be paying too much money for. So there's lots of different use cases in the open banking space. Adoption to date's been quite good. There's a new paper out in terms of the roadmap forward for that, which is quite aggressive. So they want to get into. There's a lot of work to be done to actually do payments properly from a bank to bank perspective, as well as extending out authorization windows and other things for open banking.
We're going back to SteadyPay itself. You've been pretty successful at raising funds over time. I think you've had 4 different rounds.
Yeah.
The last one back end of last year.
Yes, so now we announced the start of this year.
Close at the start of this year. So £3 million in your back pocket. Where's it going? Where's the main driver for you? I mean, people talk. You were saying about your ideas a tenner penny. So your roadmap is in that category of aspirational tenner penny stuff. So how are you going to spend the $3 million? What's the main driver? Is it people? Is it product? Is it evolution?
Good question. I'm glad you didn't ask how hard it is to raise money. So,
we'll come on to that in a minute.
So for us, roadmap has predominantly been, product focused, but product with an embedded skew. So I say that from what we've built out over time is a big platform. The platform is comprised of our AI-based credit risk engine, income smoothing, and various configurable lending solutions. So almost lending as a service when you think about it. And what we really have underlying the technology is obviously a set of FCA licenses, a set of lending operations teams, so highly trained people that can have any of those repayments, financial difficulty, vulnerability type conversations, as well as a pool of liquidity that to be able to lend, or to be able to plug in someone else's balance sheet if they choose to. So what we're driving towards now with that investment is, yes, we're going to continue to expand out our direct to consumer offering. We're launching another product this month. But we're also working with a number of neobanks and marketplaces to embed components of our products into their solutions. So
almost white label.
Correct. So when you think about for a lot of those neobanks, many of them, boring detail, but run on an EMI license, so they actually aren't licensed at the moment to lend money. But their customers, they're now at a stage of they've got tens of thousands or more customers, hundreds of thousands maybe. Are looking for those credit solutions. So by working with us, we're able to sort of quite easily plug our stack into theirs. They can offer either, I'd say, more traditional lending products, still decisioned by us, or they can offer more innovative products, which they're quite excited about. So they can do anything from what we call like a retro BNPL. So take a transaction. I bought a printer for £1,000. And then effectively get that money back into your account, finance it over 3 months. I think I call that responsible buy now pay later, because you actually had the money, but through to income smoothing. Or it's from me.
You talked about your FCA license. Do you want to just remind us what SteadyPay have in terms of their FCA authorizations?
Sure. So we're licensed for consumer credit and payments. And those are the first two licenses that we got way back in into 2019. And then over time, we've added credit information and credit broking. So we want to be able to understand people's credit information and be able to improve their credit score. And we also want to be able to appoint representatives. So part of those neobanks, they end up going under our umbrella of licensing, or marketplaces go under our umbrella.
So have you already got the ability to do AR?
Yes.
Brilliant.
Yeah.
And that's quite an achievement, in of itself.
Yeah. Yes. So we have quite a good relationship with the FCA. I think it's one of those funny things that we've had asked from a lot of people over time. How do you do this? Or how do you do that with the FCA? And I'm happy to my top tip for the FCA, because a lot of people are, I haven't heard back, and yes, there's a lag to get a case manager, but my top tip for anyone when they're going, we're bogged down with something, is have you had a face-to-face, whether that's over Zoom or actually really in person with that person? And if you haven't, you need to think of an excuse to do that as soon as possible.
Yeah, I think relationships are key in any challenging environment. So we talked about your fundraising and stuff, and there's the metrics that you look at as a founder. What do you think are the key metrics that your investors are looking at?
They remind me at every board meeting.
So rattle them off.
So from an investor's perspective, and I think it's important for a founder to be aligned, because I think that there was a period where we'd have metrics and we'd be looking at a dashboard and it didn't align with what the investors wanted, or there wasn't a sufficient overlap. Let's put it on those terms. So from the investor's perspective, when you think about the investors, yes, they're looking for the moonshots. So they're looking to measure some of their internal stuff. So that they want to see you growing. And they want to see you growing at a decent rate. So what's your growth rate?
What's a decent rate?
So for them, most of them would be, I actually use it as forward planning. So if you're doing it on a yearly basis, so the first 4 years, triple, double. That's what you want to do with your revenue. So that first year it was 100K. You want to triple it. You want to triple it again, then you want to double it, and you want to double it, and then your VCs will be happy.
You're 5 years and you're sorted.
And then you sort of sounds so easy, isn't it? But then they're also looking at, what's your CAC and what's your CAC to LTV.
Yeah.
But other than that, most other things, obviously, they're interested in the loan book and the loan book performance, but it's less interesting to them because they're assuming you're taking care of it.
Yeah. So it's that growth, and so long as the CAC to LTV is sensible, it's growth. Do you think that's changed over the last year?
I'd like to say yes, but not really. What has changed is more of an interest in cost.
Yeah.
So
and that's what I was trying to get at.
So you'll see some of the multiples that they'll ask for if you're doing a round, or metrics you ask for when you're doing a round. They are looking at burn multiple as the new kid on the block, which I'll be honest,
burn multiple.
Yeah, I'd never heard of it. But it's interesting. So they are looking to say, okay, if we give this much money, how long is it going to last, and where are you going to be at, and can you get to profitability? So there are more metrics around that path to profitability that have come up, but fundamentally you still need a high growth business because that's what VCs are investing in.
Yeah, it's that future cash flow that they're banking on. Which is not surprising. So when you look at the next horizon, we talked about the money that's gone in, the growth of the team. You're going to look to keep that steady. What are and we know about the North Star metrics. Is there a set of numbers or something that's out there that you look at as part of your dashboard? Because I can imagine you have 100 different line items on your theoretical dashboard here, but is there something that's out there that you're concerned about that would, let's say, for instance, either macroeconomic or within the team, or what is it that you have in your mind's eye as a founder? Because only you will know these 2 or 3 things, these different signal makers out there that will either get you excited about opportunity or make you think this is something to be concerned about. What are those that, because for each founder they'll be different, but if they can hear a few different examples of these signal makers.
Yeah, no, it makes sense. So we'll go inside out. So from an inside perspective, like inside the business, so because you're looking at the other thing we haven't really talked that much about, but is how healthy is your internal business? Yeah. Is the team working well together? Are your team performing? Are they happy? Are they conforming well to the cultish behavior that you want to instill in them? I'm joking, maybe. I'm
sure we'll see when we pop around. Yeah.
Exactly. But the reality is, internally, there's a few different ways of looking at it. But from a tech team perspective, you're wanting to see velocity and throughput. Yeah. So if you don't have some measure of velocity and throughput of your tech team, get it in place, because otherwise you'll just get excuses, and they're well-intentioned excuses, but it's just how it works.
So you've not heard the phrase that it's difficult to assess velocity in a product or an engineering team.
It's difficult. It's difficult to do a lot of things. It's difficult to raise money. So it's more about you have to have some form of measure. There's nothing wrong with failing a sprint. Forget to macro detail. Where the problem is, if you don't know you really failed the sprint and you didn't learn anything from failing the sprint. So the most common reason for failing a sprint is taking too many tasks into a sprint. So it's pretty obvious, right? But the thing is that those tasks then spill over into the next sprint. What are the chances of delivering all those tasks in the next sprint? I don't know. But really, that's how you start to measure that sort of internal velocity on the tech side of things. And then really for me, I've usually on the rest of the team, from a customer service or customer success standpoint, we have sort of a bit of internal and external, trust pilots and other things that give a bit of a view of what's happening from the voice of the customer, and we have a couple of really good people on the team that really champion that for us. So I can actually almost rely on those people to be the canary, if you like, to be like, oh no, there's I think there's a problem. And we've had times where some of the people, I think there's a problem, and they've known about a tech issue prior to the tech team actually knowing about it. So in a small team, we talked about earlier, when you've got a relatively small team, the sum does need to be greater than all the parts. So you literally, as opposed to, I joked that a corporate 1 + 1 is 1. In a startup, 1 + 1 doesn't need to equal 3. So you need to sort of break some of those rules to try and get a real value multiplier. So that's sort of when I'm thinking about it internally, that's generally those are sort of the main areas I'm looking at. And obviously the custom one gives you a little bit of the external stuff. Then when we're sort of taking it to the business level, and we've touched on CAC and CAC Delta V and those sorts of things. What I tend to do is I say two things. So one is this, there's some metrics that I have a look at that I do tend to find quite leading. So what is our conversion rate? So, and because that's actually telling me that
how do you assess your conversion rate? Because there's a conversion, whether it's a sales conversion, whether it's marketing conversion.
Good point. So when I say conversion, I mean the percentage of people, because obviously it's parts of the whole funnel conversion, right? When I'm talking about the conversion number that I'm looking at is the how our risk engine is converting people. So basically, how many people it's saying no to. That is a great proxy for the health of the gig economy. So it's something I want to. Eventually, I should publish as like a gig index.
I actually think you should. The information that you have, massive insights.
So that's one that starts to tell me, it starts to tingle your spidey senses of conversions up or down, and it has gone. And we're not talking about 0.2%. We're talking about up variations of 5+% at various points in time. So there's COVID being a good example. Like conversion was down. That was an easy
big surprise.
Easy macro on that one. It's like, how did that happen? I know that one. But it can tingle your spidey senses. Then you can start having a look. And then for me, what I'll actually then tend to do is, so we use Intercom for all our customer conversations. There will be times when I'll actually just go through and just scan the conversations. Basically have a quick look, have a zip through and see it, and get a feel for how it is. So it's one of those weird ones that there are hard metrics that can give you a indication of one thing or another, and then you need to also try and have a feel for it. So that's that combination of numbers and gut almost.
Going back a little bit, you talked about all the different parts of the organisation feel their piece is tough, and on a couple of occasions you said, well, raising funds is tough, and it is. There's no question. I don't think there's anybody out there who will find that as straightforward as they may have perceived. That said, investors are critical. So for you, what did you find the most difficult piece of that process?
So in terms of difficulty of raising funds, I'll break it into two things. So early, I would say, and this is more of a being slightly self-reflective, that early on when you're a new founder trying to raise funds, there are certain things you think that you could have done that would have made you better at raising funds. So here are the two things that I wish I'd done prior that would have made me better at raising funds.
Brilliant.
The first one, bigger network. So the bigger your network, the better it is. I'm not talking about network of VCs. Well, that would be helpful. But the bigger your network, the easier it is for you to make those connections to raise funds. And the second one, the better storyteller you are, the better you are to raise funds. So I'd almost say, go to a storytelling boot camp, because I think that I wasn't that good a storyteller. I'm still probably average. So the better you can get at it, and the more succinct you can make that story, the more convincing you're going to be when you're trying to raise those money. So that's sort of here's me in hindsight saying, well, what coulda, shoulda, woulda. Then when we're actually in the throes of raising funds, fundraising process is just like is a sales funnel. So fundamentally, you need to treat it like a sales process.
Bunch of prospects,
exactly.
Qualified leads.
Bunch of prospects, qualified leads. A no is a no, a maybe is a no. I'll get back to you as a no. Anything other than a yes is a no. And even a yes followed by 6 weeks of silence is also a no. So you need to take a weirdly sort of ruthless approach of sort of that sales funnel when you're going through it. I'd say what I've also found is, and I found this in the last round, I needed to talk to 3x the number of investors, because investors are significantly more skittish than they were. So it is taking either more time, or you need to be more convincing. Having a data room that's relatively robust, good to go at the start, but that's just part of running a good
process.
Part of running a good sales process. But then if you're going in, you're wanting to have that clear story. You're in the best possible position. But again, part of that good sales process is, you've qualified out some of them because they don't invest in your area, or they're too late, they're too early. Don't waste your time, because as a founder, it's one of the few things you've got is time. So you need to use it quite wisely.
You've got time.
Yes.
How much time do you have as a founder? So that's a strange statement. It's a strange. You say the one thing that you've got is time. It's the one thing that I think I find difficult.
Difficult, but it's your most precious resource.
Absolutely, it's your most precious resource.
So when I say the one thing. I mean, some people say the only thing you've got is equity as well, but it's your most precious resource. So you need to be very careful about how you do it. And I don't mean to sound like a miser, but you almost need to be miserly in your
I actually think that is one of the most important things you've said, John. Literally.
Yeah.
That, and I think I misunderstood your first statement there. But yeah, how you use your time.
Yeah.
It is the most valuable resource.
Yeah.
And waste it at your peril.
Absolutely. And I'd say that, this is part of the running a tight sales funnel for investment. If you think about VCs especially, they're in the data business, just in case everyone's wondering they don't know that they are in the data business. So they want your data. So they will talk to you to get your data. They may have absolutely no intention of investing in you. So be very careful of
at the moment, you'll get hundreds of cold calls or emails in especially from the US. I mean, it's always been the case, but it seems to be 4 or 5x in terms of the numbers of these folks, and it just eats your time. Yeah. Initially, as you say, you might think, somebody's interested, let's have a chat.
Absolutely. You hopefully you quickly learn the lesson of I
think you're absolutely right, and there's a cluster of folk at the early stages in their VC journey, as it were, and they're literally just trying to collate and mine data.
Yeah.
And that's all it is. And you do need to be mindful of that's going on. Otherwise, you could eat your time.
It can absolutely eat your time. So it's be miserly with your time. And when you're thinking about, I don't know how you do it, but when I'm thinking about any given day, it's like, what is the most valuable thing I can do today? And I remember another founder gave me what I thought was a really good piece of advice, which was, being a founder is, you have to be really good at prioritizing. And so, but what you actually do is you take your priority list, and let's say there's the 5 things at the top of your priority list, and you just keep doing number 1 until it's done. Even though number 2 and number 3 are yelling at you, you keep doing number 1 until it's gone.
That's interesting.
And I thought it was quite interesting.
Yeah. That is profound, actually. But do you find that you have, in a day, are you closed out in 7.5 hours of work? Are you done?
No. So I'd like to say that
Even though you've only got number one to focus on, mate.
Yeah, it took me 10 hours to do number one. So I'd find that over time, I'd say I've gotten better. So first year or two of startup, very all-consuming, lots of time, lots of weekends, and it makes sense. Smaller team, you're really trying for things,
and everybody's relying on you. Ultimately, the buck stops with you.
But buck stops with me. Are you going to make payroll? Early days had a few of those. Are we going to make payroll? Over time, if you really, once you start getting into sort of multi-year, the easy is a marathon, not a sprint. It is true. However, if you're not getting more efficient with the time, then you are in trouble. So for me, I do try to stick to a work window, and not go too far out of that window. But more so for me, I'd say what I've found is it's more important to schedule in the other stuff. And so when I say other stuff, it's sort of, if you find that, exercise or swimming or walking or whatever it is your thing, then schedule that in. So it's almost kind of weirdly, if it's for me, it's actually everything's sort of scheduled in the calendar, and maybe the calendar is filled till 10 p.m. But it's not actually full. There's dinner and there's lunch and there's go for a walk or whatever it happens to be. Otherwise, for me, I found that if I don't schedule it, then there is the potential I could still be sitting there at the laptop until 10 p.m.
Yeah, way too easy. I would have to say that I've probably got a lot to learn on that from you, and I think I will certainly take that little trick away with me. I guess, all I can say is thank you so much for your time, precious as it is, and the piece of wisdom that you've shared with us today, certainly around the funding challenges and obviously the metrics, which really appreciate. Thank you very much, John.
You're welcome. Thank you. It's been great talking.
Thank you for joining us on this episode of Founder Metrics. Remember, even the biggest of ambitions are within your reach when you leverage the right strategies and metrics. If you enjoyed this episode, be sure to subscribe and never miss a future episode. You can visit vested.com, Founder Metrics, for additional resources, articles, and exclusive content. Join our growing community of entrepreneurs and founders by following us on LinkedIn or X. We'd love to hear your thoughts. Together, let's continue to unlock the metrics of success, sharing, and create a brighter future.